This stock is growing earnings per share 20% year over year. Its revenue is up nearly 14% year over year, and they just announced another 15% dividend increase. They've grown that dividend 300% over the past 10 years, which is a 14.8% compound annual growth rate. The company just reported earnings and they beat consensus by 12.6% on earnings per share, yet the stock sold off 5% the next day. That stock is Intuit, ticker symbol INTU. That's the software giant that owns TurboTax, Credit Karma, QuickBooks, MailChimp, and more. The stock is a victim of the SaaS apocalypse where investors are fleeing from software companies. Right now, Intuit stock is down 56% from its all-time high. That's despite the company being at its record high in earnings per share and showing continued high growth year after year. Today, I'm going to explain why now, after this major sell-off, it may be the best time to buy Intuit stock in over 10 years. With that said, let's roll the intro and get into today's stock analysis video. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Now, full transparency, I don't own Intuit stock in my personal portfolio, and I am not buying it today as I make this video. However, this company is on my watch list, and I have been following them for a few years now. And if you're a dividend growth investor or a value investor, Intuit stock is looking pretty attractive on most metrics. So as always, you should do your own research before making any investing decisions. But I'm going to give you my thoughts and analysis on Intuit stock. So first, let's just start on the big picture. Over the long run, Intuit has proven to have very good returns in the market. In fact, even after selling off 56% from its all-time high, if we go back to its IPO back in 1993, the stock is up 14,857%, which is a 16.15% compound annual growth rate. And if we take the stock back to 2024, the total return was a 19.39% compound annual growth rate. That's well ahead of the broader market in that time. And over the past decade, the stock has been on a fantastic tear of earnings growth. Adjusted earnings per share is up 536% over the past 10 years, which is a 20.86% compound annual growth rate. Now, this has slowed down a little bit over the past 3 years, but not that much. It's up 59% in that time, which is an 18.59% compound annual growth rate. And the company generates serious cash flows now, $8.62 billion of free cash flow over the trailing 12 months. That's up 41% year over year. Over the past 10 years, their free cash flow is up 907%, which is a 26.75% compound annual growth rate. And this is why at-scale software companies like Intuit can be very attractive. They have super high margins and they have low CapEx. This is a CapEx-light business. So all the profits they generate, for the most part, turn into free cash flow. That means they can reward shareholders with share repurchases and a growing dividend payment. Over the trailing 12 months, they spent $5.53 billion in share repurchases, which if you're a long-term believer in the stock and you think it's at a low valuation right now, honestly is a great deal. In general, you want to do share repurchases when you think your stock is undervalued, and you're seeing some of these software companies start to ramp it up as the software sell-off has happened. Intuit as an example, and then you have Salesforce, which is doing it even more dramatically, even taking on debt to buy back their stock. As I mentioned, Intuit is a dividend growth stock, and that's a big part of their shareholder returns. They've been paying a quarterly dividend since 2011, and they've raised it every single year. The dividend has doubled over the past 5 years with a 15.26% compound annual growth rate, and the company just approved another dividend increase, which is a 15% increase from the prior year. And they have remaining authorization for $7.9 billion of additional share repurchases. And if the company keeps growing their earnings and free cash flow like they have been, then this dividend payment is going to keep going up in the years to come. They have a 15% free cash flow payout ratio right now and a 29.5% earnings payout ratio. That's based on GAAP earnings per share. And if you're a dividend investor who likes to optimize your yield on cost and entry point into the stock, this is the best time to buy Intuit stock in over 10 years. It's currently in the 98th percentile dividend yield with a 1.41% forward-looking dividend yield. And aside from the absolute low, which happened a few weeks ago on Intuit stock, there has never been a higher yield you could have bought the company. Even if you go back to 2011 when they started paying the dividend, it's always a 1% yield or less. Over the past 10 years, the median dividend yield has been 0.72%. So the stock is definitely in deep value territory and trading at a lower multiple than it ever has. That's true with earnings per share as well. Over the trailing 12 months, GAAP earnings per share gives you a P/E ratio of 20.8. This is the second lowest percentile over the past 10 years. This is a reliable software company with very high margins and steady growth. Previously, software stocks have commanded a premium multiple in the market. Over the past 10 years, the median multiple for trailing 12 months P/E ratio is 48.27. This 20.8 multiple is historically low. However, on a forward-looking basis, Intuit is expected to continue growing. It's currently trading at a 12.5 forward-looking P/E ratio. This is one of the lowest P/E ratios you could have bought the stock at in over 10 years. And I think you can make the argument that Intuit stock is in deep value territory. So I'm going to give you some thoughts of how you could value Intuit stock, what kind of returns you could see if you bought it here in the long run, assuming that the business continues to maintain, slowly grow, or even grow at its current rate. I'll also give you an idea for price projections going forward. And if you want to use all of the research tools I'm showing throughout, including this value graph, which I'm about to dive into, it's all available at dividenddata.com. It's the best stock research and portfolio tracking tool, especially if you're a long-term investor, a value investor, a dividend investor. We currently have a 50% off sale to celebrate the next generation of our tool, which we launched last month. And if you sign up before Labor Day weekend, you can lock in 50% off annual membership and keep that discounted price for life. Honestly, it's a no-brainer, and if the tool helps you find just one better stock, it way more than pays for itself. The link is in the description and pinned comment, or you can scan the QR code in the bottom right corner of the screen right now. But let's dive right into it. So right now we're looking at one of our custom tools, which we call the value graph. It lets you see the price versus fair value for a bunch of different metrics, and that is determined by taking the median multiple of the selected metric over the selected time period. So to start, we're going to be looking at trailing 12 months adjusted earnings per share. We looked at the GAAP earlier in that PE analyzer. So adjusted earnings per share over the trailing 12 months is $24.32. At today's price, that implies a 14.05 PE ratio. If we look over 10 years, the median multiple in that time for trailing 12 months adjusted earnings per share has been 37.08. So you can see the stock is currently trading 59% that implied fair value if they return to the median multiple they usually trade at. This is the largest gap over the past 10 years. And on an all-time basis, this is a historically low valuation. As you can see, during 2020 and 2021, Intuit stock was trading well above its implied fair value. Even in 2025, it was trading above its fair value. And that's why even if you're buying a great company that's continually growing over time, you can't overpay for the stock, because if sentiment switches up and growth doesn't accelerate to match that more premium multiple, you're going to see a sharp decline like you have with Intuit stock. The sentiment has completely shifted on it and the broader software sector. They're no longer paying a premium multiple for software stocks. And while most investors are now scared off of the sector and Intuit stock, for the long-term investor who does their homework and feels comfortable about the long-term prospects of Intuit, this could prove to be a great buying opportunity. Because what you have to keep in mind is that the actual fair value and intrinsic value of Intuit continues to grow year after year after year. That's because their earnings and cash flow are growing year after year. So going back to 2007 here, the median adjusted earnings per share trailing 12 months P ratio has been 30.7. And if Intuit stock were to return to that 30 times multiple, that would give it an implied fair value of $747, which would be 118% upside from here. And that would just be from a re-rating of the multiple back to its historical median. You would then have the compounding of actual earnings growth underneath it. From a dividend perspective, if we want to go back to 2011 when they initiated their dividend payment, the median dividend yield for Intuit stock in that time has been 0.88%. We're talking forward-looking dividend yield. It's currently 1.41%, and that's prior to their new 15% dividend increase. And you can see that the company has been trading above that historical median for quite a while, but now it's at the largest discount since they've started paying their dividend. If they returned to that 0.88% median multiple, That would give it an implied fair value of $545, which would be 59% upside from here. Free cash flow is the most extreme metric to look at here for the value graph. As I mentioned earlier, their free cash flow growth has been outpacing all the other metrics. $31.68 over the trailing 12 months. That's currently a 10.7 price to free cash flow multiple. And if we look all time on Intuit stock back to 2007, the median price to free cash flow multiple has been 25.82. That makes Intuit stock today priced 57% below its implied fair value. If the company returned to that median multiple, it would give an implied fair value of $817, which would be 139.5% upside from here. But again, Intuit stock is growing, making more free cash flow in the long run year after year. So the fair value is growing on top of that. Now I'm going to give you a price projection on Intuit stock, given a base case where they don't get the multiple expansion back to the historical median. And then I'll give you an example of prices you could expect if they get a re-rating higher. And this will be based on analyst expectations for earnings per share growth in the coming years. After that, I'll also give you the Wall Street price targets and latest ratings after this latest earnings report. All right, so for the price projection, we're going to be taking these analyst ratings, and then we're going to be applying what we think the price to earnings ratio would be at that time. And this is to give you a rough ballpark of what you think the price estimate would be. So right now we're assuming a forward-looking P ratio of 12.7. So we're using that as the target benchmark. So just to outline this here, in 2028, analysts are expecting a consensus non-GAAP earnings per share for the year of $30.80. And if you apply a 12.7 multiple to that, so you're taking 30.8 times 12.7, that would give a projected price of $391. So we're taking this all the way through 2030. Now, it should be noted there's only 3 analyst estimates for earnings per share in 2030. At least according to my data. I'm sure we'll update as we get closer to it. The implied price projection by 2030 would be $511. That would be 47% upside from here, 10.4% annualized growth. And again, this is assuming that Intuit stock does not get any re-rating upwards. You're assuming that software stocks are going to stay trading at this low multiple while they're continually growing 10 to 20% a year. So that means that Intuit would be trading at a significant discount to a lot of slower growth kind of consumer staple companies, things like Coca-Cola, Procter & Gamble, PepsiCo. And this re-rating downward has to do with investors being concerned about the long-term cash flows of software companies like Intuit. And that's up for you to determine in your analysis buying the stock. Do you think Intuit 5 or 10 years from now will be the same kind of business, or will AI just completely erode all software companies? That's up for you to determine, and that's why the stock is cheap. Stocks like Coca-Cola and PepsiCo still trade at a higher multiple because people are more confident in the long-term cash flows of the stock, even though they know growth isn't going to be that high. So that's part of the game when investing. However, if Intuit does get re-rated even slightly higher, the returns could be very impressive. Let's say they trade at a 20 P ratio, and that would give a 2030 price target of $805, which would be 132% upside from here. That's 24% annualized growth. That will likely be well ahead of the market. If they trade at a 25 PE ratio, that'd be a $1,007 2030 price target, which would be 190% upside. That'd be 31.2% a year. And if they go back to the median historic of 30, that'd be $1,208 a share, 248% upside, 37.5% growth annualized. That's part of the opportunity here with buying a stock that has sold off a ton and is in deep value territory relative to its historic multiples, especially when it's expected to continue growing at a high rate going forward. But what is Wall Street saying about Intuit stock? We're going to be taking a look at the latest 12-month price targets. This is coming right after their latest earnings report. We just got a bunch of new price targets. And part of the reason why the stock was going down is a lot of the price targets got lowered following this earnings report. We just had 7 analysts lower their price targets. But for context, those 2 who raised the price target, both of them are still below the current stock price. As you can see, we have a $300 one when the current price is $357 and a $290 one. And most of the analysts who lowered the price targets, they were actually well above the current stock price. You had a prior one that was $450 lowered to $400, and we're talking a 1-year out price target here. We have a $350 lowered to $300, $406 lowered to $380, $427 lowered to $415, $443 lowered to $408. So overall, I'd say Wall Street is still pretty mixed on Intuit stock. I did read through the company's earnings report, and the growth seems to be pretty good, even with their outlook. They gave guidance for Q1 2027, and on the bottom line, so operating income and earnings per share, they're expecting pretty solid growth. Although GAAP earnings per share, they're only expecting 8 to 10% annually. And one of the big reasons for that is that non-GAAP earnings per share excludes stock-based compensation. And a lot of these big software companies, they do a lot of stock-based compensation to incentivize their employees to stay with them in the long run. So that's excluding $521 million of stock-based compensation. So it's definitely something to consider, and software stocks definitely are not getting away with that anymore. Stock-based compensation was a big talking point over the past 5 years, and especially during that ZERP era in the private startup environment. A lot of public software stocks, it wasn't being looked at as an expense, but it is a dilution to shareholders. That said, in recent years, Intuit's share count is going down, and they are ramping up share repurchases, so you should expect that to go down even more. Shares are down 2.5% year over year, so they definitely are more than offsetting dilution from employee stock-based compensation. But when you're analyzing Intuit stock, that's where you get the difference between the adjusted earnings per share, so the non-GAAP, and the GAAP earnings per share. The other thing that I noticed is that revenue growth is decelerating at Intuit. For the first quarter of fiscal 2027 in their guidance, they put 11% year-over-year growth. And here you can see for the full year, they're expecting 9 to 10% annual growth. But in the big picture, the cash generation of Intuit is growing very strong. For a mature company, 20% annual increases, and they're actually guiding above that. That's pretty impressive at this multiple. So overall, in terms of valuation, looking at Intuit stock right now, after earnings, after it's sold off, this is probably one of the best times to buy Intuit stock in over a decade. Let me know in the comments if you agree, if you're buying Intuit stock, what you think about software stocks in general. And again, if you want to use dividenddata.com, now is also one of the best times to buy dividenddata.com. We have a 50% off sale. It's going to end pretty soon. So if you want to try it out and use all the tools I showed throughout the video, link is in the description and pinned comment. If you're an investor like me and the tool helps you find just one better stock or avoid a potential mistake, then it way more than pays for itself. With that said, thanks for watching, and I'll see you in the next video.